For Americans who grew up in a country that used to build everything, cars, appliances, sneakers, it's like someone broke into your childhood bedroom and took all your stuff, right? I mean, it's wild to think about how much has changed. We've seen trade wars, tariffs, and endless political debates swirling around this massive economic shift, and it's hard not to notice, you know? But here's the kicker. Some experts argue that China isn't just competing, they're bending the rules a bit. They've got this whole strategy going on with their currency, the yuan, which they manage to keep artificially cheap. That means their exports can flood the market at lower prices, putting American companies and other foreign competitors at a serious disadvantage. It's like a game where the rules keep changing, and not in a fair way. So how does all this work? And does it really matter to us? Let's break it down. Most countries aim to sell more than they buy. That's called a trade surplus. When a country imports more than it exports, that's a trade deficit. Politicians love to scream about deficits because it sounds scary, like your country is losing at life, even though free trade usually increases overall wealth. It's kind of ironic, right? Take the UK, for example. Not that long ago, Britain had a booming car industry: Vauxhall, Rover, Jaguar. Sure, some of those cars were closer to rolling lottery tickets than reliable transportation, but they employed tens of thousands of people. The government stepped in to make sure foreign competition didn't completely steamroll them by slapping on tariffs. Imagine this. You could buy a Toyota Corolla that might actually outlast a Vauxhall Astra. But if the UK added a 30% import tax to that Corolla, suddenly the domestic car looked like the better deal. Consumers stuck with the local option. Local jobs were saved, and the government got a small economic boost. A temporary win for everyone involved. Now zoom out and look at the United States. We saw something similar during the auto industry bailouts of the late 2000s. Protecting local jobs sometimes comes at a real cost: higher prices, fewer choices. But in turbulent times, it can keep entire industries alive. It's a tough balancing act. Fast forward to today, and most economists agree: competition is king. Consumers win with better products at better prices because companies are forced to actually compete. That's one big reason tariffs have become less common over time. But countries are still hunting for sneakier ways to gain an edge, often in ways that aren't immediately obvious. Enter currency manipulation. When a country deliberately lowers the value of its currency, two things happen. First, imports become more expensive. That protects domestic industries in a way that feels a lot like tariffs, just quieter. Second, exports become cheaper for foreign buyers, which boosts sales abroad. For the country doing it, it's a win-win. Now picture this. You're choosing between a Cadillac and a Mercedes. Normally, they might cost roughly the same. But if the US dollar suddenly lost half its value, that Mercedes would feel insanely expensive to an American buyer. Suddenly, the Cadillac looks like a bargain. And just like that, American manufacturing gets a lifeline. All without passing a single tariff. But it's not one-sided. This also means Germans suddenly find American-made goods cheaper. With the same number of euros, they can buy more Cadillacs, computers, or sneakers. Sure, most Germans aren't dumping their beloved Mercedes for a Cadillac overnight, but you get the point. Currency values have a massive impact on trade flows, corporate profits, and who wins in the global market. Now, some of you might be thinking, wait, if I trade $10,000 for yen, shouldn't I be rich? Not quite. 1 million yen buys roughly what $10,000 does in the US, once you adjust for the cost of living. Over long periods, free-floating currencies tend to balance out, even if the numbers look wildly different on paper. Here's the crucial part. China isn't just letting the market do its thing. They're actively devaluing the yuan to maintain a strategic edge. Think of it like this. Imagine Apple announces a stock split. You own 10 shares and suddenly you own 40. Sounds amazing, right? But each share is now worth 1/4 of its original price. Your total investment didn't actually grow. That's essentially what's happening with China's currency, except instead of helping small investors, the goal is to make Chinese exports more competitive on the global stage. So how does China pull this off? It's pretty simple. They become the market. In most countries, currencies are traded by countless buyers and sellers, from tourists exchanging money at the airport to banks moving billions of dollars in foreign exchange. But China? They set a fixed rate and say, this is the price. Take it or leave it. If the government says $1 equals 5 yuan, that's what everyone trades at. You won't find someone offering 4 yuan per dollar because you just use the government exchange. And no one's offering 6 yuan either, because they could do better at the official rate. The state becomes a constant backstop, keeping the currency where they want it. Of course, this isn't cheap. The government needs massive reserves of dollars, euros, yen, and pounds to back up these trades. But over time, most transactions happen privately because everyone trusts that the official rate will be honored. It's like a digital trust fund for the entire economy. Fun fact: the cost of maintaining this system is roughly equivalent to the deadweight loss tariffs create. Tariffs make goods more expensive for consumers, while currency management costs taxpayers directly. Either way, bending the rules comes at a price. And for those of you who are a bit entrepreneurial, this creates some interesting opportunities. Your dollars are effectively overvalued in China, so you could buy more goods, bring them home, and sell them at market prices. Wait a minute. Isn't that just importing stuff from China? You got it. You're playing the exact same game China set up. Clever? Yes. Revolutionary? Not really. So, should we be mad about this? Maybe, but probably about as mad as you'd be about tariffs. It's just part of the global economic game, and China is playing by its own playbook. It's frustrating, but it's also the reality we're living in. The good news? China is slowly letting the yuan float more freely. Market forces are starting to matter more, and the yuan could eventually become a widely accepted global currency, maybe even challenging the US dollar one day. But that's a whole different story for another time. For now, the takeaway is crystal clear. Currency, trade, and market intervention are complicated. They affect everything from the price of sneakers to car manufacturing to billions in global commerce. And while it's super tempting to get outraged, the truth is that every country, including the United States, has used similar tactics at some point. So next time you see a headline about currency manipulation, remember, it's complicated, it's strategic, and it's just economics doing what it does best: shaking things up.